Well, we're having a review session today, and we're going to be talking about the Chapter 10 problem. Keep in mind, although you probably have the same dollar values in the problem that you're looking at, there is a chance they could be different, but the problem is the same, and the techniques, the calculations that we do would still be the same. You just need to make sure you're using the numbers that are in your problem if they're different than what you see on my screen. So the chapter 10 is about current liabilities, installment notes. And so what we're going to be doing in part 1 is journalizing a whole series of transactions that happened for this company during a particular year. And all of these transactions will be related to current liabilities, notes, using simple interest calculations, maybe accruing some interest. I can see just looking at these that we have some notes that are discounted and some notes that the interest is on top of the principal. And so we'll have a chance to practice with all of those. So we'll start with the April 15th transaction. And we borrowed $225,000 from Audi Company on a 30-day note at 6% interest. So what happened on April 15th? Well, we received some cash from Audi Company. It was a total of $225,000. So our asset cash is going to go up by $225,000, but we have to pay it back. Not only do we have to pay back that face value or principal, but we also will need to calculate and pay the interest on that. And that will be due 30 days from April 15th. And that would be May 15th. Next thing that happened on May 1st, we bought some equipment. And to buy that equipment, we didn't have the cash available. And so we had to borrow the money. We issued a note to our supplier. So we were buying that equipment from Spider. And we said, you know, if we could just have a little bit of time to pay, we'll be glad to pay you interest. And so we issued a 180-day, about 6-month note to Spider for the value of that equipment. So now we have the equipment we can use, but again, 6 months from now, we'll need to pay for the equipment along with 6% interest to compensate Spider for allowing us additional time to pay. So the equipment at had a value of $320,000. We're going to put that on our balance sheet, but we have to pay for it. Did it say we? Oh, and they discounted the note at 6%. Okay. So they discounted the note. Let me change that. So let's figure out what the interest is. Remember, in class this week, we did one example of a discounted note. I'm going to put the calculation here on the screen. So the simple interest calculation we know is I equals PRT. And in this case, the principal is $320,000. The interest rate is given at 6%. And then the T, the time period, needs to be expressed as a portion of the year. And I'm assuming that we are going to use a 360-day year as we have been for all of these calculations just to make it easier. So 320,000 times 6%, and that's half a year. The interest is $9,600. And so when we discount the note, we are reporting the interest expense up front, and then the amount we pay back is the full face value. So the interest expense is $9,600, and the value of the equipment then would be not the full $320,000, but instead we subtract the interest expense from that, report the interest expense at the same time that we make that note. And then the value of the equipment is not the full face value of the note, because when we discount the note, the interest is included in that face value. In other words, we subtract the interest from the principal or the face value of the note. And that's what we mean by discounting it. We're removing the interest. Okay, so stop me if you have questions. If you don't have questions, I will just keep going. But please, if you do have questions, feel free to stop me and ask. Now it's 30 days since we made that note to Audi Company, and we need to pay that note. It's due, but we don't have the cash apparently to pay it yet. And so we're just going to pay the interest on the note and then basically reissue the note extend it for another 60 days. And you'll notice the interest rate we are now paying is 8%. So I don't know whether that 8%, which is higher than the original 6%, I don't know whether that reflects a change in the market. So interest rates have gone up in that 30 days, or if we're considered more risky now. And so they're a little bit more concerned. They want a little bit more compensation for taking that risk. I really can't know that from what we see here. But it asks us to record both the debit and the credit to the notes payable account. And that's a little bit odd that you would debit and credit the same account, but I think they want us to see what's happening. So we're taking this note that we had set up on April 15th of 225, and we're going to clear that out. Okay, so we're going to debit that original note to clear it out of the system, so that when we put the new note in, there it is. So when we put the new note in, we can enter the new payment terms, that it's 8% and now it's another 60 days. So it's very unusual to have the same account debited and credited, but that does allow us to enter those payment terms like we talked about back in chapter 5. In this case, the interest rate, the due date, and so on. And what we are going to do, it says, is pay the interest. So we're going to credit cash and debit interest expense, but I need to calculate that interest. So let me get my annotator back up here, and we'll do another interest calculation for that April 15th note. Principal was $225,000. This note was not discounted, so the interest is on top of that $225,000. The entry from April 15th included a debit to cash for the entire amount, and then the interest is on top of that. As I said, when we talked about it in class, if you were the borrower, you would prefer to have the interest on top of the face value. If you're the lender, all else equal, if you have the same stated interest rate, we would prefer to have the interest discounted if we are the lender. If we're the borrower, we prefer to have the interest on top of the face value. And then this was a 30-day note, so 30 out of 360 to change that into the portion of a year. And I got 1,000, whoops, where did I go? $1,125 is the interest that has accrued in those 30 days. So we'll report interest expense of $1,125, and we're actually going to pay that and roll the note over for another 60 days at 8% rather than 6% interest. Good with that? Now we move ahead. So we've issued that note for another 60 days, and 60 days later, in the middle of July, we have the money now to be able to pay that note. So we still owe the full face value of $225,000, but in addition to that, we have to pay the new interest. So simple interest formula again, principal still the same. Remember when we renewed this note, the interest rate went up to 8% and now it's 60 days. And the interest is $3,000 now. So it's more than twice as much as the interest on the original note because the duration is 60 days rather than 30. It's twice as long, and the interest rate is also higher. And so now on July 14th, we are going to pay the full amount that is due. So we're going to credit cash, and we are going to clear out or zero out or reverse that note payable because we no longer are going to owe that amount. And we're going to record the interest expense for this 60-day period of $3,000. So the amount we actually pay back, the maturity value, is the face value plus the interest, or $228,000. Hopefully we're good with those. Now we move ahead to August 16th, and we buy some merchandise on account from, I don't know how to pronounce that, Exige company. The merchandise is worth $90,000 and the terms are net 30. So if we're using a, there it is. If we are using a perpetual inventory system, we would add that inventory immediately to the inventory account. If we used a periodic inventory system, remember from chapter 5, we would add that to a merchandise purchases account. And the credit side is to accounts payable because we owe Exige company, and the terms were net 30. So 30 days from now, we should be paying that bill. But what happens? On September 15th, for whatever reason, we're not prepared to pay Exige that $90,000. Maybe we don't have it, or we have some other use for that money. And so instead, we ask Exige to extend our payment due date, and we agree to pay 6% interest. So give us 45 days more, and we'll be glad to pay you the full amount along with the interest. So on September 15th, we move that liability out of accounts payable and into notes payable. We're going to debit accounts payable. So back here on August 16th, we credited accounts payable to show we owed that amount. Now we move it out of accounts payable and into notes payable. We can enter the new payment terms into our system, including the interest rate and the time, the maturity length of the note, so that our system is flagging us. So, hey, we need to pay that note when it comes due 45 days from now. On October 28th, then we're going to pay the amount that's due. And so we need to do another interest calculation. Lots of practice we're getting here with this simple interest formula. So our next interest calculation, the note was for $90,000, and it was a 6% interest rate, and it was for 45 days. So 90,000 times 6%, 45 days. $675. And so we're going to go to September 15th. Nope, sorry, not September 15th. The next one is October 28th. And we're going to pay the full amount due on that note. So it's the $90,000 that was the face value plus the $675 worth of interest. Wait a second, what did I miss? I wonder, we should have another. Oh, I'm sorry. So the one that I just did now was the Exceed company note. So that's October 30th. So I was looking, couldn't figure out why I didn't have a line for the interest. Let me try this again. So the note was for $90,000. We're going to pay the $90,675. So I misread that. We're going to pay on October 30th is when that 45-day note was due. That makes more sense. So October 30th, we're going to pay this $90,000. We'll come back to the one on the 28th in a moment. So we're going to pay the $90,675. That is for the note. That's the face value. And then the interest. So I couldn't figure out why I only had 2 lines there. Okay. Now I can go back and read what that October 28th transaction was. What happened on October 28th? Spider Manufacturing from May 1st. Oh, okay. So that was the discounted note. And that's why I only had 2 lines there, because back on May 1st, we already reported the interest associated with that note. And so since that note was discounted, when the due date comes up on October 28th, we pay the $320,000, the full face value. We have already, there we go. We have already reported the interest on that. That's why I only needed 2 lines there. I just got my notes confused. This company's borrowing too much money. I couldn't keep all of their borrowing straight. I don't mean that that was a bad business decision. I just mean it's too many things for me to keep track of in my head without putting them into the computer. Moving ahead then, unless there are any questions. On November 16th, we purchased store equipment from Gallardo Company for $450,000. That's the value of the equipment. We paid $50,000, so that's like the down payment. And then we're going to finance the other $400,000 by issuing a series of 20 9% notes, $20,000 each, coming due at 30-day intervals. So every 30 days until we've paid off the full $400,000 plus interest. Every 30 days, we're going to pay $20,000 plus the interest. 20 months later, we will have paid off the rest of that balance. So let's go to our journal entry and think about what happened. So on November 16th, we bought some equipment, and the full value of the equipment was $450,000. We made a down payment and issued a series of notes for the rest of the balance. 20 notes at $20,000 each is a total of $400,000. And now every month, when the next installment note comes, or the next note comes due, we're going to pay the $20,000 of principal for that one note plus the relevant interest. So on December 16th, the first note matures after just 30 days. So we're only going to pay 30 days worth of interest. And I think that interest rate was 9%, right? Yep, 9%. So on December 16th, we're going to pay the first note that's only been outstanding for 30 days. And this is a $20,000 note at 9% interest. And this has only been outstanding for 30 days. The second note, when it matures the next month, will be 60 days, and the third one will be 90 days. So each successive payment is actually going to be for a higher amount, right? So 1 month's worth of interest, let's do this calculation, 20,000 at 9% for 30 days is $150 of interest for the 30 days. Next month, when the second note comes due, we will owe $300 worth of interest because it's 2 months. The next note, it's $450 and then $600. Each successive note, we're going to pay the $20,000 that is the principal or the face value, and each one owes $150 in interest more than the previous one. So let's pay our first note here. We're going to get rid of or debit notes payable for $20,000. Report the interest expense of $150, and we will pay $20,150. In January, on January 15th, when this next note comes due, we'll pay $20,300. The following month, $20,450, and so on. And then the last thing that happens, on December 28th, we settle the personal injury lawsuit with a customer for $87,500 to be paid in January. Aston Martin accrued the loss in a litigation claims payable account. Okay, so we have agreed to pay $87,500, but we're not paying it this calendar year. We're going to pay it next year. But because that lawsuit has been decided against us, we need to show in our records that we now owe that money. So remember at the very end of class yesterday, I talked about Monday. I talked about contingent liabilities just a little bit. It said, when we're facing something like a lawsuit, we are required to consider the likelihood that we will lose and then may owe some money. And if we determine that it's likely that we will not be successful, that we will lose that lawsuit, we are required then to estimate how much our risk or exposure or potential liability is and report that in the appropriate financial statements in that same time period. And we'll report that as a loss. This loss, the debit part, shows up on our income statement and reduces our income in this period. And the credit part shows up on our balance sheet as a liability. Okay, any questions about where we are right now? So those are the actual transactions that we are reporting in real time throughout the year. And the next part, the last part of this exercise, asks us to, at the end of the year, do the adjusting entries for these two items. So the first item is a product warranty cost. So if we are accruing this This means that this is the estimated warranty liability that we have based on this year's sales. This is how much we think we might incur as cost in a future period, but we need to set it aside now because of the matching principle. We have to report that expense in the same period that we reported the revenues. And on our balance sheet, we need to report that estimated warranty payable in the future. As with all adjusting entries, we need to have one balance sheet and one income statement account. And the whole point of the adjusting entries is to make sure that our financial statements reflect the costs and revenues in this period. And then letter B, we need to report the interest on the 19 remaining notes owed to Gallardo Company. So let's go back up here and look at the details of that. Okay, so here's the information about that. On November 16th, we issued 20 notes. Remember, one of them we paid off in December, but the other 19 are still outstanding, and they've been outstanding since November 16th. So we've got to calculate how much interest has accrued. We will pay the next note on January 15th, but at the end of this year, when we're closing out our records, we need to report the interest that is owed on those other 19 notes. So let's calculate that. Remember, we had borrowed originally $400,000, $20,000 we already repaid. So the remaining balance is $380,000. The interest rate, I didn't repeat the whole I equals PRT formula, but you can see it there 5 times on the screen. I don't really have enough room to put that in here. The interest rate on these notes was 9%. Now this is the part I have to calculate. How many days is it? Well, there are 30 days in November, and we made or issued the note on the 16th. So that would be 14 days in November, and then there are 31 days in December to get us to the end of the year. And we need to express that as portion of a year. So same formula. The only thing that wasn't as clear to us that we had to calculate was how many days since those notes were originally issued. And that is 14, so it's a total of 45 days. 380,000 times 9% times 45 days out of 360. And so the interest that has accrued, $4,275. That's $150 a month times 1.5 months times 19 notes. And so we now know the interest that has accrued on those notes is $42.75. Whoops. And so we're going to report that. We're going to do an adjusting entry to accrue that interest expense and report the interest payable. Now, when we pay the next note in January, we have to remember that included in this interest payable is $225 for each one of those notes. So we'll have to include that as part of our entry. We're not reporting all of the interest expense. We're only reporting interest expense since January 1st and removing a little bit at a time the interest payable that we have recorded here, $225 for each one of those notes.
Check that.
Give me 1 second. Okay, so we did some investigating, and I looked at what the software thinks the answer should be, and I'm just going to tell you that their answer is wrong. because their calculation, they did exactly the same calculation that we did here, except rather than using 45 days, they used only 30 days. And that's not correct because the note was made on November 16th and we need to report the interest for all 19 notes, $380,000 total, since the time the notes were made. The only interest we had reported up to this point was the interest we paid on the first note on December 16th. So my calculation here that we did is correct using 45 days, but for in order to get credit for it, because I don't have the ability to change the software, what I want you to do is calculate this based on 30 days, which I think was $28.50, but let me just recalculate that. Yeah, $28.50. So please, in order to get credit for it, put $28.50 in this part 2B for the interest expense and interest payable. And I will notify Cengage that there's an error because that definitely should be 45 days of interest from November 16th to the end of December. I'm going to pause the recording again.